All right, so you've decided that enough is enough. It's time to stop procrastinating on your financial future, and finally, you're ready to start investing in the stock market. So naturally, you've started educating yourself by watching my videos, and you've headed on over to a stock brokerage, but you're immediately stopped in your tracks by being presented with all of the different options for the account types that you can open to start investing with. Well, luckily, whether you're Canadian or American, I guarantee you that you'll finish today's video knowing exactly which account type to start with, the reasons why, and how each one of these accounts works. Now, this might sound like basic information, which it is, but in reality, there are only 15 million Canadians that have a TFSA, representing only around 50% of the population above 18 years old. And in the United States, only around 23% of taxpayers own traditional IRAs, while about 10% have a Roth IRA also, meaning there's still a lot of catching up to do. So if you're new to investing, my name's Griffin, and this channel is all about getting you on the right track for financial success. And what better place to start than speaking about investment accounts? Let's get into it. First of all, you might actually not even be aware of this, but to hold investment vehicles such as stocks, ETFs, bonds, whatever it might be, you actually have to have an investment account that is separate from your traditional bank account. Unfortunately, you can't just start buying shares of Tesla, Apple, or whatever other company you want to invest in without first opening up a dedicated investment account, also referred to as a brokerage account. That's a term you will be hearing in the world of investing. And this is because a stock brokerage is essentially a company or a division that takes charge of managing investment transactions. So with this in mind, there are many different types of brokerage accounts available to investors both in Canada and the United States. But the most popular that we'll be covering in today's video include the TFSA, RRSP, cash and margin accounts, as well as the traditional IRA and Roth IRA in the United States. And if we have time, we'll also briefly speak about the 401k, which is only available in the United States. The next basic concept to understand here is that some of these account types will fall under the category known as a non-registered account, while others will fall into the category known as a registered account. And the main difference between these two account categories, while there are many, ultimately boils down to tax sheltering implications between the registered versus non-registered accounts. So the registered accounts are pretty much managed and kept track of by the IRS in the United States, as well as the CRA in Canada. That's the reason why when you open up, say, a TFSA, which is a registered account here in Canada with either Wealthsimple Trade or Questrade, they will require your social insurance number. I've had multiple viewers ask me why this is and whether or not it's legitimate, but yeah, they need your social insurance number so that they can properly identify you, communicate effectively with the government about your trading activities, and also keep track of your contributions. All of this to say, though, that it's these tax sheltering capabilities of the registered accounts that make them so appealing to investors, especially when you're first starting out. On the other hand, non-registered investment accounts, including cash as well as margin accounts, both in Canada and the United States, pretty much are the most bare bones options available that have no tax sheltering benefits whatsoever, other than naturally just the favorable taxation of capital gains as well as dividend income, which are taxed favorably over earned income. If you're just starting to get into investing though, well, most likely the best option for you will be a registered account. So let's first start with my favorites being the TFSA in Canada, as well as the Roth IRA in the United States. So both of these registered accounts, the TFSA and Roth IRA, are available either in Canada or the United States, and depending on your citizenship, you'll only be able to access one. But the reason why I'm grouping them together right now is just because they are very similar, and actually we'll be doing the same thing with the traditional IRA as well as the RRSP. The TFSA stands for the tax-free savings account, while the Roth IRA stands for the Roth Individual Retirement Account. And both of these accounts allow investors to make contributions that will grow over time on a tax-free basis. So when you go to withdraw your funds later on down the road, you do not have to pay any tax whatsoever on those funds, regardless of how much they've grown to. To make this less confusing though, let's first start with the TFSA and then we'll speak about the Roth IRA, and depending on your interest, I'll leave timestamps here so you can just skip ahead. So the tax-free savings account was introduced in 2009 and allows Canadians to invest post-tax dollars to the account up to a yearly maximum contribution limit. However, these contributions can grow over time, compounding and incurring dividend income, and later on down the line when you withdraw those funds, it will be completely tax-free. As a quick example, let's say you made $50,000 last calendar year and contributed $5,000 to your TFSA. Well, in that year, you will still need to pay income tax on the entire $50,000. However, let's say 20 years down the line, if that $5,000 contribution has grown to $20,000, you can withdraw that entire $20,000 amount completely tax-free. Now, unfortunately, you can't just contribute your entire life savings to your TFSA right now. There are yearly contribution limits imposed by the Canadian government, but the good news is that these contribution limits per year are actually cumulative. So let's say that you turned 18 years old in 2008 and you've never contributed to your TFSA whatsoever. You have some hefty contribution room waiting for you. In fact, from 2009 to 2012, the yearly contribution limit was $5,000. From 2013 to 2018, the annual limit was $5,500 a year, except in 2011 where the limit was $10,000. And finally, from 2019 to 2021, we have a limit of $6,000, meaning that if you turned 18 before 2009 and have never contributed to your TFSA, you would have a total cumulative contribution limit of $75,500, which is really decent. If you'd like to learn more detailed information about how you can actually grow your contribution room, as well as some mistakes to avoid, then I'd highly recommend you check out one of the 2 videos that I'm overlaying right here about the TFSA specifically. And what's great about the TFSA is that you have full control over your money, meaning you can make withdrawals pretty much whenever you want without incurring any penalties or additional taxes. Moving on to the Roth IRA available to Americans, this account is very similar to the TFSA in that you are contributing post-tax dollars to the account with the goal of growing those contributions on a tax-free basis. However, there are some main differences here. First of all, unlike with the TFSA in Canada, where you can pretty much freely move your money around if you need it in the shorter term, well, with the Roth IRA, you actually cannot withdraw your contributions and any earnings on those contributions without incurring taxes as well as penalties unless the account is at a minimum 5 years of age and also you're above 59 and a half years old. In addition to this, contributions are not cumulative, which is a total bummer because this means if you've never contributed to your Roth IRA, well, you can start this year, which is great and a good start. However, you will not be able to backtrack on any of those contributions that you missed in prior years. So with this in mind, there's no real importance in looking at what the maximum contributions were for prior years, because if you didn't make those contributions, unfortunately, you lost them. Now, in the last 2 years, 2020 as well as 2021, the maximum contribution you can make to your Roth IRA was $6,000. And if you're above 50 years of age, it is $7,000 as the total maximum contribution. What's more is that depending on what's known as your modified gross income, you might actually not even be eligible to make any contributions whatsoever. This table right here shows some of these different scenarios. So for example, if you're single and have a modified gross income of over $140,000 in a year, unfortunately, you would not be eligible to make any Roth IRA contributions at all. Even further, the maximum $6,000 is just that, a maximum, where based on your modified gross income and tax filing situation, you need to calculate your Roth IRA limit for the year. This is never the case with the TFSA in Canada. Regardless of your income as well as your age, as long as you're above 18 years old, you can contribute up to the maximum yearly limit. For once, Canada is doing something right here. Moving on now to the RRSP and traditional IRA. From a tax sheltering standpoint, these accounts are essentially the opposite of the TFSA and Roth IRA, where your contributions in the year you make them will be tax deductible from your total taxable income in that given year. However, those contributions will not grow tax-free over the course of your investment career. So later on down the line, when you make those withdrawals to, let's say, fund retirement, that will be added to your taxable income in that given year. Again, let's start with the Canadian option being the RRSP, which is an acronym for Registered Retirement Savings Program. And just like with the TFSA, there are contribution limits imposed for your RRSP. However, the calculation of these contributions is entirely different. Instead of a yearly predefined limit, the RRSP contribution is actually going to be 18% of the prior year's total income that you reported on your tax return. So again, if you made, say, $50,000 last year, well, 18% of that would be $9,000, and $9,000 would be your contribution limit for the next year towards your RRSP. And once again, really great here, all of this is cumulative. So if you've been a worker for a decade now and have never contributed to your RRSP, chances are you have a quite hefty contribution room waiting for you. This is an account that can greatly reduce your tax bill in the year of the contribution. And the idea here is that over time towards retirement, most likely your income will gradually decline. And so adding those withdrawals to your taxable income will probably not be all too burdensome from a tax standpoint. Taking a look at an example here of how the RRSP contributions can affect your taxable income. Once again, let's say you made $50,000 in the year and you made a contribution of $9,000 towards your RRSP. Well, this will have a material impact on the amount of tax owing in that given year, as we can see right here. The proper use of both the TFSA and RRSP combined make up for an investment and tax strategy that pretty much only you can determine based on things such as your investor profile as well as your age. So definitely give it some thought, and if you need more guidance, consult a professional. Now with the traditional IRA, again, while this account is somewhat similar to the RRSP here in Canada, it does have some main differences related to calculating the contribution room. In fact, there's actually no calculation to be done in order to determine your contribution room. Instead, the total contribution room in a given year is shared with your contribution room for your Roth IRA, which is set at $6,000 right now if you are below 50 and $7,000 if you are above 50 years old. With that said, your contributions to the traditional IRA are tax deductible in the given year that you make those contributions. For example, this year's limits to your IRA account, granted that you are eligible based on your income at all, would be $6,000. So if you invest $4,000 into your Roth IRA, unfortunately, you'll only be able to contribute $2,000 to your traditional IRA for that given year. This is definitely a major disadvantage to these American retirement accounts, but the United States does have one account that somewhat makes up for this that we do not have in Canada, called the 401k. The 401k is a work-based retirement plan where employers can choose to match their employees' contributions up to a certain amount per given year. So in this light, this is basically a 100% return on investment if you're an employee who has access to a 401k, where if you're making a contribution of say $5,000 and your employer matches that at $5,000 also, not even taking into account any of the growth of those funds, you're already looking or starting with a 100% return on investment. And company retirement plans generally have a higher contribution limit than either a traditional or Roth IRA. Employee 401k contribution limits for 2020 and 2021 were $19,500, which is quite substantial, especially if you can get this amount matched. Now, even though in Canada we don't have a specific 401k account, some employers can choose to match contributions made by their employees to their RRSP account. So if that's something that is available to you within your workplace, definitely take advantage of it, because not only will this be a tax deduction in the year that you make your contributions, it's also a 100% return on your invested capital right away. So with all that said, what would be my recommendation as to which account to open first for investment purposes? Well, first of all, it should be a given that your first investment account be a registered investment account so that you can take advantage of tax sheltering capabilities, whatever that might be. Now, when it comes though to the TFSA or Roth IRA versus the RRSP and traditional IRA, ultimately this is going to come down to your personal situation right now and what makes most fiscal sense. So definitely run some scenarios, but 90% of the time, at least in my experience, newer investors are better off starting with the TFSA or Roth IRA because you are younger, and then over time, as your account has time to compound and grow, it's going to make better sense to not pay any taxes on the growth of your investment account. But again, that's just my view. Make sure to give it some thought and base your decision off of your own personal realities. So with that said though, that pretty much wraps up today's video, and I hope it was able to get you on the right track for knowing which account type makes most sense to start investing in. If you enjoyed today's video, make sure to give me a like. That's all I ask in return. Finally, of course, make sure to check out the links down below to resources I use and recommend where you can get some free money. So on that note, thanks a lot for watching today's video, and I will see you in the next one.